Welcome to the Deep Dive, your go-to source for untangling complex information and transforming it into clear, incredibly useful knowledge.
Glad to be here.
Today, we're embarking on a mission that's foundational for so many of you, mastering the SAFE exam. This isn't just about getting by the way. Our goal for you is crystal clear, to truly ace it, to score that perfect 100-100.
Absolutely. Because when it comes to the SAFE exam, precision is everything. You really can't afford to be fuzzy on the details.
That's right. For this deep dive, we're not just skimming the surface. We're going to dissect the most vital regulations for loan officers, guiding you through the intricate world of mortgage laws with, well, absolute clarity.
Our shared goal is for you to walk away not just informed, but deeply confident. With every key definition, every rule, and every nuance locked firmly in your memory.
We'll be your expert guides, cutting through all the noise to get straight to the core knowledge you need for exam success, and just as importantly, for a strong, ethical career in lending.
Think of this deep dive as your ultimate targeted study session. We're going to pinpoint the most important facts.
The ones that really matter for the test.
Exactly. We'll clarify those commonly confused points that often trip people up on the exam.
And critically, we're going to deliver direct, verbatim quotes from the primary source material.
Yes. Why that verbatim emphasis? Because for the SAFE exam, that textbook fidelity is paramount.
You absolutely need to know these definitions cold, exactly as they're written, to secure that perfect score. No paraphrasing in your head when the question demands the exact wording.
So get ready to absorb, connect, and truly understand these regulations. This is your shortcut to being exceptionally well-informed for your exam and, more broadly, for building a robust, compliant foundation in your lending career.
Let's make sure you're ready to crush it.
Good.
And we're starting with a big one, a foundational piece of mortgage regulation that's crucial for protecting consumers every single day. RESPA. That's the Real Estate Settlement Procedures Act. This is the law that truly pulls back the curtain on the costs of getting a mortgage, and it's implemented through Regulation X.
Exactly. The Real Estate Settlement Procedures Act, or RACA, along with its implementing regulations, known as Regulation X, you can find that at 12 CFR Section 024.1 at SEC, are primarily enforced by the Consumer Financial Protection Bureau.
The CFPB,
Yeah.
our primary watchdog for consumer financial products.
That's the one.
And when we talk about its core purpose, it's really about fairness and transparency in the mortgage process.
Absolutely. It's about leveling the playing field.
Our source material lays out those purposes very clearly. It states that the purposes of RECA are two: protect consumers from excessive settlement costs and unearned fees.
Okay, first purpose.
Limit the amount of funds that creditors can require consumers to deposit into escrow accounts.
Second, limits on escrow.
And third, establish disclosures, policies, and procedures to facilitate timely communications between loan servicers and consumers.
Communication rate.
And this isn't just theory. It's designed to tackle real problems that existed.
That verbatim quote is exactly what you need to recall for the exam. And, understanding the why behind it really helps solidify that memory.
Makes sense. Context helps.
Yeah. Historically, the mortgage industry had significant issues with hidden fees, kickbacks, just a pervasive lack of transparency.
Right. You wouldn't always know what you were really paying for.
Exactly. Imagine, for instance, a situation where you apply for a mortgage, and unbeknownst to you, your lender is getting a secret payment from the appraiser just for steering you their way.
Inflating your costs with no real benefit to you.
Precisely. RESPA was specifically designed to tear down that wall of hidden charges and make the entire settlement process truly transparent.
So it's about ensuring that borrowers are not exploited through inflated costs or hidden charges, making the consumer's journey much more upfront and clear.
That's the core idea.
So who does RESPA actually apply to? This is a critical distinction for the exam, so you really need to listen closely to the types of loans that are covered versus those that are exempt.
Very important distinction.
Our source identifies covered loans as federally related mortgage loans, secured by a first or subordinate lien on residential property.
Right.
That's a broad category.
It is. And to expand on that, this includes, but isn't limited to, FHA or VA loans. Those are insured or collateralized by the federal government. Loans from federally regulated lenders, like those regulated by the FDIC or NCUA.
Banks and credit unions, basically.
Right. Also, loans intended for sale to Fannie Mae or Freddie Mac, those huge players in the secondary market,
Mm-hmm.
and loans made by tightly regulated creditors or mortgage brokers who assign the loan to a federally related creditor.
So a lot of common loans.
Pretty much. So, for example, your typical home purchase loans, refinances, approved assumptions, property improvement loans, HELOCs, and reverse mortgages all generally fall under RESPA.
Now, here's where it gets really interesting and where you need to be sharp for that perfect score on the exam. The exception. Pay attention here. RESPA does not apply to these specific types of loans. Generally, if it's not a consumer purpose loan for a primary residence, it's often exempt. So it does not apply to loans for business, commercial, or agricultural purposes.
That's a big one. Business or farm loans, not RESPA.
Also, temporary financing, like construction loans. Unless, and this is a common exam trick question, so watch that, unless they're convertible to permanent financing by the same lender.
Right, that conversion piece is key. If it's just a short-term construction loan that ends, no RESPA. But if the same lender rolls it into the permanent mortgage, RESPA applies.
Good clarification. Also exempt. Loans secured by vacant land, unless the proceeds will be used to construct a 1 to 4 family residential structure within 2 years from the settlement date.
Again, that unless is critical. Vacant land itself, no RESPA. But if you're building a house on it soon with that loan money, RESPA applies.
Also exempt are loan assumptions without lender approval. So if the lender isn't involved in the assumption, RESPA doesn't apply.
Makes sense. If the lender doesn't approve, they aren't part of the settlement.
Transactions between lenders and investors for the sale of a closed loan in the secondary market. RESPA focuses on the primary mortgage market, the initial transaction with the borrower.
Right. The buying and selling of existing mortgages between institutions isn't what RESPA is about.
And finally, loan conversions when a new note isn't required and the provisions are consistent with the original mortgage.
Think of RESPA as primarily focusing on the front-end costs and disclosures of consumer purpose mortgages for buying homes.
Right, protecting the individual home buyer.
Exactly. If the loan is for a business, agricultural purpose, or certain temporary financing situations, it's generally outside RESPA's scope. This is a common point of confusion for test takers, so truly understand that distinction. It's about protecting individuals buying homes, not large-scale commercial transactions.
Got it. Consumer purpose is key.
Definitely.
And speaking of understanding, let's nail down some of the key definitions under RESPA. For your SAFE exam, you're going to want to memorize these verbatim quotes because they are the foundation for many exam questions.
Verbatim is the word here.
First up, affiliated business arrangement. A relationship where service providers have an ownership interest in other settlement service providers, which must be disclosed to the borrower. Profit sharing is permissible under this arrangement.
Yes, and understanding that profit sharing is permissible if disclosed is absolutely crucial for the exam. A lender owning a title company isn't automatically illegal as long as their relationship and potential benefit are disclosed properly.
Okay. Next, agreement or understanding. A stated, written, or even unwritten agreement established through a practice or pattern of conduct to offer things of value for the referral of settlement business.
This is incredibly broad. It means it doesn't have to be a formal contract. A consistent pattern of behavior, maybe taking someone to lunch every time they send a referral, is enough to constitute an illegal agreement if it's for referral.
Right. Okay, very broad. Then we have bona fide discount point. Points paid by the borrower to reduce the interest rate, where 1 point typically equals 1% of the principal loan amount.
Straightforward, but essential for cost calculations.
And here's one often confused. Borrower credit, also known as yield spread premium or YSP. The definition.
Yeah.
A fee paid to the borrower by the lender for originating a loan at an interest rate higher than the lowest rate for which the borrower qualifies. This credit is used to subsidize closing costs.
That's a crucial one to understand. YSP is about getting a credit from the lender for accepting a slightly higher interest rate, which you can then use to help cover your closing costs.
Trading a slightly higher long-term cost for a lower upfront expense.
Precisely. Think of it that way. Moving on. Fee splitting and kickbacks.
Right.
Paying or accepting unearned fees or marking up a fee for a service and splitting the overage with another provider.
This seems like the heart of RESPA's anti-fraud provisions.
It absolutely is. It's designed to prevent people from getting paid for services they didn't actually perform or just for steering business.
And tied to that is markups, an upcharge in the actual cost of a settlement service where the additional fee is retained. Now, this is a really important nuance for the exam and a common point of confusion.
Okay, let's clarify this carefully.
A unilateral markup, meaning a service provider, say an appraiser, charges you $500, but only paid the actual appraisal company $450 and keeps the $50 difference. That unilateral markup itself is not a RESPA violation.
Right. Under RESPA, the violation occurs if that $50 upcharge is split with someone else, like the lender who referred the appraiser. RESPA Section 8 is focused on the splitting of unearned fees.
Exactly. However, and this is critical, we'll see later when we discuss TILA, that the amount charged for a service cannot exceed the amount received by the provider for purposes of the finance charge calculation. Any retained markup is included in the TILA finance charge.
Excellent point. That's a vital distinction. RESPA prohibits the splitting of the markup. TILA addresses the retention of the markup and its inclusion in the finance charge calculation. You have to keep those two laws distinct in your mind for the exam.
Super important nuance there. Okay, next definition. Mortgage broker. A person, other than a lender's employee, who provides origination services as an intermediary between a borrower and a lender.
Pretty clear. And referral. An action, written or oral, that influences the selection of a settlement service provider.
Again, very broad.
Intentionally broad, yes, to prevent hidden kickbacks or subtle steering.
For settlement service, our source explains it as any service provided in connection with a real estate settlement.
And this covers a huge array of services. The source lists things like loan origination, services by a mortgage broker, title services, services by an attorney, document preparation and recordation, credit reports, appraisals, inspections, various types of insurance, services for real property taxes, and services by a real estate agent or broker.
Basically, if it's part of closing a loan, chances are it's a settlement service under RESPA.
That's a safe assumption. Then there's sham affiliated business arrangement, a partnership or joint venture created for the illegal purpose of splitting fees under the guise of a legitimate affiliated business arrangement.
So setting up a fake company just to funnel kickbacks.
Exactly. It targets deceptive practices that try to skirt the rules by creating a fake business relationship just on paper.
And finally, thing of value. Includes any payment, advance, loan, service, money, discount, commission, salary, stock, opportunity tickets, or special financial arrangements given in exchange for referrals.
Again, incredibly broad. It's designed to catch anything of benefit given for a referral, not just cash. Sports tickets, a special loan rate, anything.
The sheer breadth of what RESPA considers a thing of value or a settlement service really shows how committed the law is to stamping out any undue influence in the mortgage process.
It's not just about blatant cash kickbacks, but even subtle agreements or patterns of behavior.
Okay, let's unpack this next section because the disclosures required by RESPA, and especially their timelines, are critical for the exam. Missing a timeline can definitely cost you points.
Absolutely. Timelines are huge on the SAFE exam.
First, the special information booklet. This is a disclosure due no later than 3 business days after a mortgage loan application is received or prepared.
Right. For purchase transactions, the content of this booklet is officially called your Home Loan Toolkit, a step-by-step guide. Explains the settlement process, borrower rights, warns about false information, that sort of thing.
And for HELA lines.
For HELACs, it's a different booklet. What you should know about home equity lines of credit.
Okay, but are there times you don't have to give it? Exemptions.
Yes, and these are frequent exam points. It's not required for refinances, closed-end subordinate liens, or reverse mortgages.
Interesting. Why not refinances?
The thinking is likely that someone refinancing has already been through the home buying process once, but remember that distinction for the test. Also, if the application is denied within that initial 3 business day period, the booklet isn't required either.
Makes sense. It's a foundational consumer education piece meant for the start of the process.
Exactly, to empower borrowers from the very beginning.
Next, the affiliated business arrangement disclosure. The timing on this is absolutely key for your perfect score.
When do you have to give this one?
It must be provided at the time of making a referral to an affiliated business.
Okay, so right when you suggest using the company you have an ownership interest in.
Exactly. Now, if the lender requires the use of a specific provider, which is rare, but the source says it can happen for things like an attorney, appraiser, or credit reporting agency, then the disclosure's due at the time of the loan application.
Ah, so required use changes the timing to the application itself. Good distinction. What about phone referrals?
For telephone referrals, a written disclosure is due within 3 business days after the call. That's a nuanced point often tested.
Okay, 3 days after the call for the written follow-up. Got it. What needs to be in this disclosure?
The content is vital for the exam. It must describe the business arrangement, including the percentage of ownership interest, indicate that the referral may result in a financial benefit for the referring party, estimate the costs from the affiliated provider,
And crucially,
and most importantly, it must advise the borrower that HESH is not required to use the service provider and that other providers are available.
that advisory part telling them they can shop around is where many test takers get tripped up. You have to tell them they have a choice, even if you own the company.
Right. But there's that exception we mentioned. Lenders can require the use of a particular attorney, appraiser, or credit reporting agency, despite that general advice about shopping.
True. Specific exceptions. And don't forget the record retention.
Good point. There's a 5-year retention requirement for these affiliated business arrangement disclosures, another common exam detail. 5 years.
5 years. Burn that into your memory.
Moving on to disclosures related to mortgage servicing, specifically the transfer of servicing, when your loan gets sold or the servicing rights are transferred.
Yes, those notices. Timelines are often tested here too.
When a loan changes hands from one servicer to another, the transfer servicer, the old one, must provide notice no less than 15 days before the effective date of the transfer.
Okay, 15 days before from the old servicer.
The transferee servicer, the new one, must provide notice no more than 15 days after the transfer.
15 days after from the new servicer. Got it.
A combined notice is permitted if it's provided at least 15 days before the effective date.
So one notice can cover both if it's early enough. Make sure you get those no less than and no more than distinctions right for the exam.
Absolutely. What's in the notice?
The content must include the effective date of the transfer, contact info for the transferee servicer, the dates during which the transferee will accept payments, confirmation that optional insurance coverage won't be affected, and a statement that the transfer doesn't change the loan terms themselves.
And there's a protection for the consumer during this transition, right?
Yes, a very important one. During the 60-day period following the effective date of the transfer, a payment may not be treated as late for any reason if the consumer sends an on-time payment to the transfer servicer.
Ah. So if you accidentally send it to the old servicer within 60 days, they can't call it late.
Correct. That 60-day grace period is an important consumer safeguard that helps prevent accidental late fees during the confusion of a transfer. It's often tested.
Good to know. Finally, for RESPA disclosures, let's talk about escrow accounts.
Impound accounts, yes. RESPA's Regulation X specifically prevents loan servicers from overcharging here.
How does it do that?
It requires an annual escrow account analysis and limits the cushion a borrower must maintain to cover unanticipated disbursements, like unexpected property tax increases. That cushion is limited to 1/6 of the estimated total annual disbursements.
1/6. That number is important for the exam.
Absolutely. 1/6 or 2 months' worth of escrow payments, same thing.
What about surpluses if they collect too much?
It also requires the refund of any surpluses greater than or equal to $50 within 30 days after the annual analysis.
$50 or more gets refunded within 30 days. What if it's less than $50?
If the surplus is less than $50, the servicer can just credit it towards the next year's escrow payments.
Okay. And there are specific statements related to escrow too.
Yes. The initial escrow account statement is typically given at settlement, but the lender actually has up to 45 days from settlement to deliver it.
45 days. Good detail. What's in it?
This statement shows the mortgage payment breakdown, the itemized estimated taxes, insurance, and other escrow items, the cushion amount allowed, and a trial running balance for the account's first year.
And the annual one.
The annual escrow account statement is due within 30 days of completion of the escrow account computation year. It includes the account history from the previous year, a projection for the next year, the payment breakdown, last year current, total paid in out, how any surplus was handled, and an explanation if there's a deficiency or shortage.
You definitely need to know those timelines. 45 days for initial, 30 days for annual, and the $50 surplus rule for your exam.
For sure, escrow details are common test fodder.
Now, let's turn to prohibited practices under RESPA. Section 8 is the absolute core for understanding anti-kickback and anti-fraud provisions. This is huge for the exam.
Section 8. Memorize it.
Our source says, Section 8 prohibits anyone from giving or accepting unearned fees, such as referral fees, kickbacks, or other things of value, unless a commensurate amount of work is performed to earn the fee.
Okay, you have to earn the fee through actual work.
And Regulation X emphasizes that any referral of a settlement service is not a compensable service.
That last part is absolutely key for the exam. A referral alone is never compensable under RESPA. You can't just get paid for recommending someone. Actual, legitimate work must be done to justify the fee.
Got it. What about Section 8B?
Section 8B prohibits the splitting of fees in situations in which fees are received for services not actually performed. This rule also states that duplicative fees and fees for nominal services are unearned fees.
So no splitting fees for fake work or charging twice for the same thing.
Exactly. And remember that agreement or understanding to violate these prohibitions doesn't need to be written down. It can exist even through practice or a pattern of conduct.
Like we discussed earlier.
Right. For instance, if a thing of value is repeatedly received and it's clearly connected to the volume or value of business referred, that's strong evidence of an illegal agreement, even without a formal contract.
This also leads us back to sham-affiliated business arrangements.
Right. The fake companies set up just to split fees.
These are arrangements created to illegally split fees under the guise of a legitimate business relationship. To prevent this, RECI lays out clear criteria for what makes a bona fide provider of real estate settlement services.
What are those criteria? This sounds important.
The business must demonstrate sufficient capital to operate. It must have its own employees. It must maintain control of its own business affairs, have a separate office. It must assume the assumption of the risks and rewards of a comparable enterprise, show the ability and willingness to perform the services it claims to offer. It must actually compete in the market for business and have business interaction with members of the lending industry other than its affiliates.
Wow, that's a comprehensive list. Basically, it has to be a real, functioning, independent enough business, not just a shell company created to receive referral fees.
Exactly. If a supposedly affiliated company doesn't meet these criteria, it's likely a sham and therefore illegal under RESPA Section 8.
Our source provides a clear scenario to clarify this common exam port, which is helpful.
Let's hear it.
A mortgage brokerage firm, Kohler Home Solutions, has a 20% ownership interest in a title company, Moreland Title Services, and regularly refers clients to it.
Okay, standard affiliated setup.
The takeaway illustrates precisely how to stay compliant. The firm fulfills its legal obligation under RESPA by providing clients with an affiliated business arrangement disclosure at the time of referral. This disclosure outlines the relationship and explicitly states that the client is not required to use the services of the affiliated company, thus meeting the requirements of Regulation X.
So it shows how proper, timely disclosure, telling the client about the relationship and their right to choose, makes the arrangement compliant, even with the shared ownership and the potential for profit sharing.
Disclosures are the key safeguard there.
Let's also cover mortgage loan servicing, which extends beyond the origination phase and is also governed by RESPA.
Right. RESPA doesn't stop at closing.
Our source defines servicing as the receipt of mortgage payments from a borrower and forwarding these payments to the owner of the loan and to third parties. This includes payments for taxes and insurance deposited into an escrow account.
Think of it as the ongoing management of the loan after closing, collecting payments, handling escrow, answering questions.
What are servicers required to do?
Servicers are mandated to maintain policies for a whole range of critical functions, providing accurate and timely disclosures, like those escrow statements we discussed, investigating complaints properly, responding to information requests from borrowers, providing accurate info to the actual loan owners, submitting current info during foreclosure processes, identifying successors in interest if the borrower passes away, evaluating loss mitigation options for struggling borrowers, overseeing their own service providers, and ensuring timely information transfer when servicing is transferred.
So it's about maintaining a fair and transparent borrower relationship throughout the life of the loan.
That's the goal.
And pay close attention to the delinquencies and foreclosure prevention efforts, because specific timelines here are frequently tested and absolutely vital for real-world compliance.
Yes, these are significant consumer protections.
These rules apply to loans secured by a borrower's principal dwelling. For early intervention, servicers are required to make live contact with a delinquent borrower by the 36th day of the delinquency.
36 days for live contact, that's specific.
And a written notice detailing loss mitigation options must be sent no later than the 45th day of delinquency.
45 days for written notice.
And regarding foreclosure procedures, this is a big one, a lender or servicer must serve the borrower with a notice of default at least 120 days before the foreclosure sale date.
120 days, that's roughly 4 months' notice before a foreclosure sale can even be scheduled. That's a significant protection. These specific deadlines, 26, 45, 120 days, are critical for the exam and for compliance, ensuring borrowers have adequate time and notice before severe actions are taken.
Definitely remember 120 days. Finally, for RESPA, let's talk about the penalties for violations. The stakes are high for the exam and in reality.
What happens if you violate Section 8?
For Section 8 violations, which deal with those kickbacks and unearned fees, these may lead to criminal penalties, including fines of up to $10,000 and or imprisonment for up to 1 year.
Wow, criminal penalties. So not just fines.
Right. These are serious consequences.
What about violations related to servicing, like escrow or transfer notices?
For servicing violations in civil actions, an individual borrower may face liability for actual damages if they can prove harm resulted from the violation.
Okay, actual damages.
If there's a pattern or practice of noncompliance by the servicer, they can be liable for additional penalties of up to $2,000 per violation.
Pattern or practice adds $2K.
In class actions, damages may not exceed $2,000 for each member of the class, and the total damages may not exceed $1 million or 1% of the net worth of the servicer, whichever is less.
So there are caps on class action damages.
Yes. And there are also specific civil monetary penalties enforced by the CFPB to remember. $118 per failure to issue an escrow statement and $236,000 per intentional failure to issue one.
Those are very specific numbers, $118 and $236.
Definitely. These civil penalties under RESPA are capped at $236,451 annually. These specific penalty amounts are absolutely worth committing to memory for your exam, as they frequently appear on the test.
Good advice. Know the penalties.
All right, shifting gears from settlement costs to an even more fundamental principle, fairness and access to credit. We're now diving into the Equal Credit Opportunity Act, or ECOA.
ECOA Regulation B.
This act is all about ensuring every creditworthy applicant gets a fair shot, regardless of who they are.
That's right. ECOA was enacted in 1974, and its core aim is to eliminate discriminatory treatment of credit applicants. It's implemented by Regulation B, which is 12 CFR Section 2.1 at state.
And who enforces it?
The CFPB's Office of Fair Lending and Equal Opportunity is primarily responsible for its enforcement.
The overarching goal, as stated by our source, is to promote the availability of credit to all creditworthy applicants, regardless of a prohibited basis.
Promoting availability. Key phrase.
And here's where it becomes crucial for the exam. You must memorize all the prohibited basis characteristics. This is a common exam question that demands precise recall.
Okay, let's list them out. This is non-negotiable knowledge.
ECOA prohibits discrimination based on race, color, religion, national origin, sex.
And sex is broad now, right?
Yes. Our source notes this protected characteristic includes sexual orientation and gender identity. That's a key modern update, important to note.
Good flag. What else?
Marital status, age, as long as the loan applicant is old enough to enter a contract.
So you can't deny someone just because they're older, assuming they can sign a contract.
Correct. Also prohibited basis. Receipt of income from a public assistance program.
Can't discriminate based on getting welfare or Social Security, for instance.
Right. And finally, exercise of rights under the Consumer Credit Protection Act.
Meaning you can't deny credit just because someone previously exercised their rights, like disputing a credit report under FCRA or rescinding a loan under TILA.
Exactly. You have to know that full list cold.
Absolutely. The law also directly addresses specific discriminatory practices like redlining.
Which is?
Refusal to make loans in certain neighborhoods due to the personal characteristics of residents. Think of it as literally drawing a red line on a map around an area and saying, we don't lend there.
Got it. And there's also reverse redlining.
Yes, it's more recent, equally insidious counterpart. That's where predatory lenders specifically target vulnerable populations or neighborhoods, often with risky, high-cost loans they might not qualify for elsewhere or under unfair terms. ECOA aims to stamp out both practices.
So which loans are covered by ECO? Is it the same as RESPA?
No, the scope here is notably broader than RESPA. ECOA applies to the extension of credit by any person who regularly extends, renews, or continues credit. This includes mortgage brokers, too, if they regularly refer applicants to creditors.
Okay, regularly extends credit. But here's a key distinction, an exam point you don't want to miss.
What's the big difference?
Unlike RESPA and TILA, ECOA applies to extensions of credit for business, commercial, and agricultural use.
Wow. Okay, that is a huge difference. So ECOA protects businesses from discrimination too, not just consumers buying homes.
Exactly. This makes ECOA's reach quite extensive. Don't assume it's only about home loans for consumers.
Good heads up.
Now for some key definitions under ECOA, verbatim from our source, which you need to know precisely for your exam. First, adverse action. A creditor's refusal to offer credit in the amount or according to the terms requested by a loan applicant.
So saying no or yes, but not on the terms you asked for, that's adverse action.
Right. Next, discriminate. Using a prohibited basis, such as ethnicity or sex, as a basis for treating a loan applicant less favorably than other applicants.
This is the core of the Act, defining what it seeks to prevent.
Then, elderly, age 62 or older.
Straightforward definition.
And pay special attention to marital status. Our source specifies the state of being unmarried, married, or separated according to applicable state laws.
Okay, those three. Unmarried, married, separated.
And it clarifies. Unmarried refers to persons who are single, divorced, or widowed. Critically, the source states, these are the only terms that creditors are allowed to use when making inquiries related to marital status under ECOA.
Ah, that's a precise point often tested. You can't ask, are you single or are you divorced, but are you unmarried is the permissible term because it covers all those non-married statuses.
Exactly right. You need that level of precision.
Let's move on to the disclosures and notifications required by ECOA, where again, timelines are key for your exam. Get these down cold.
First up, the notice of action taken. When is this due?
It's due within 30 days of receipt of a loan or credit application. That's 30 days after getting a complete application.
And if adverse action is taken, what must the notice include?
It has to provide specific reasons for the unfavorable decision, state clearly that ECOA prohibits discrimination, include the creditor's name and address, the name and address of the federal agency that enforces compliance for that creditor, and if the decision was based on info from a credit reporting agency, that agency's name and address too.
What if there are multiple applicants?
Notice generally only needs to be given to one individual, typically the apparent primary applicant.
Okay. What if the application wasn't complete?
Then there's a notice of incomplete application, also due within 30 days of receipt of an application that lacks information needed to make a decision.
What does that notice say?
This notice must state the specific information needed, set a reasonable time period for the applicant to submit it, and advise them that failure to provide the missing info means the creditor won't give the application any further consideration.
Makes sense. Give them a chance to complete it.
Another important disclosure area under ECOA is valuation disclosures, especially concerning appraisals.
Appraisals, okay. What are the rules here?
A notice of the right to receive a copy of all written appraisals is due within 3 business days of receipt of a loan application. So early notice of that right.
3 business days for the notice. When do they get the actual appraisal copy?
A copy of all appraisals and other written valuations must be provided promptly after they are completed, or at least 3 business days prior to consummation, whichever is earlier.
3 business days before closing to review the appraisal. That seems important.
It's a critical consumer right. Borrowers can waive that 3-day timing before closing, maybe if they're in a rush, but they still must receive a copy at or prior to consummation, even with a waiver.
What if the loan gets denied or withdrawn after the appraisal is done?
The valuation copy is still required, but the deadline is extended to 30 days after the date on which the creditor determines the transaction will not proceed. They still have a right to see the valuation used in the decision.
Okay, good to know. Then we have disclosures regarding monitoring programs. This ties into HMDA, right?
Yes. HMDA, the Home Mortgage Disclosure Act, which we'll discuss later. For every credit transaction secured by a dwelling, creditors must request information on the applicant's ethnicity, race, sex, marital status, and age. This is often called the Government Monitoring Information Section, or Section X on the standard application.
And what does ECOA say about explaining this to the consumer?
Our source states that ECOA requires creditors to explain to consumers that this is a request from the federal government in order to monitor compliance with anti-discrimination laws.
So make it clear it's for monitoring, not for the credit decision itself.
Exactly. And here's an important point for the exam. If the applicant refuses to provide this information voluntarily, creditors must also inform applicants that they are required to provide this information based on visual observation and surname.
Wow, really? So the lender makes their best guess if the applicant declines.
Yes. This ensures data collection for fair lending monitoring even when applicants decline to self-identify. It's controversial, but it's the rule.
Good to know for the exam. Finally, record retention under ECOA.
Creditors must keep certain records, including the application itself, any information gathered for monitoring purposes, other info used in the evaluation, and the notice of action taken or notice of incompleteness for at least 25 months after notifying an applicant of the action taken or the incompleteness.
25 months. Another specific time frame to remember.
25 months for ECOA records.
Let's delve into the prohibited lending practices under ECOA. This is where the rubber meets the road in terms of preventing discrimination, and these are often highlighted on the SAFE exam.
Definitely. These are the actions ECOA forbids.
First, overt discrimination. This is the most blatant form, like a direct refusal to offer credit solely because of someone's ethnicity or religion.
Redlining, which we mentioned, refusing credit in certain neighborhoods based on residents' characteristics, is a classic example of overt discrimination. It's clear and intentional bias.
Then there's disparate treatment. What's that?
This is when a creditor treats a loan applicant who is a member of a protected class differently from other loan applicants who are similarly situated but not members of a protected class. Our source highlights this as one of the most common forms of discrimination because it can be more subtle than overt bias.
So maybe asking for more documentation from one applicant than another based on a prohibited factor, even if their financial profiles are similar.
Exactly. And then there's disparate impact. This is trickier. It's where a seemingly neutral policy, applied equally to everyone without discriminatory intent, still ends up having a disproportionately negative effect on a protected group.
Like a minimum loan amount policy that might disproportionately exclude minority applicants in lower-cost housing areas.
That could be an example. Disparate impact is harder to prove, but it's still a violation under ECOA if the policy isn't justified by legitimate business necessity.
ECOA also prohibits prohibited inquiries about protected characteristics, except for that government monitoring we discussed.
Right. You generally can't ask about race, religion, etc. unless it's for the HMDA data collection.
And discouragement. What falls under that?
These are oral or written statements that might deter prospective applicants from even applying based on a prohibited basis, like telling someone, we don't usually make loans to people in your situation before they even apply.
Got it. Now, here's a nuance alert for the exam regarding requiring a cosigner. This is a tricky area.
Okay, let's clarify cosigner rules.
Creditors are prohibited from requiring the signature of an applicant's spouse or of another person who is not a joint applicant if the individual qualifies on his or her own for credit.
So if someone qualifies alone, you can't force them to bring on a cosigner, even their spouse.
Correct. However, our source adds a crucial caveat. In community property states, the creditor may deny a loan application if the applicant's spouse refuses to sign the security agreement.
Community property states have different rules because the spouse might have a legal interest in the property even if they aren't on the loan application itself. So needing the non-borrowing spouse to sign the mortgage or deed of trust, the security instrument, in those states is allowed to protect the lender's collateral interests.
That is a key distinction that frequently appears on the exam. It's not about making the spouse a co-borrower obligated on the note, but about securing the property interest in community property states.
Exactly. It's a common area of confusion. To illustrate this, our source gives us a scenario.
Let's hear it. This will help.
An MLO, Rex, is working with a married couple, Angelica and Christopher. Angelica is pregnant and applying for the loan individually with a higher income and better credit. Rex continually asks about the coming child, their future family plans, and whether Angelica intends to keep working after giving birth, expressing concern about this possibility. He also states that because they live in a community property state, Christopher will need to be a cosigner.
Okay, lots going on there. What's the takeaway for ETOA?
The takeaway is crucial for understanding ECOA violations. Rex's inquiries regarding Angelica's pregnancy and presumptions about her intention to stop working are explicit and discriminatory violations of ECOA. That's clear discrimination based on sex, pregnancy, and marital status assumptions.
Right. Can't ask those questions or make those assumptions.
However, the source continues, his statement about needing the non-applicant spouse, Christopher, to sign certain documents is permissible and not a violation of the law in a community property state, as it is necessary to secure the creditor's interest in the property upon default or death.
That scenario perfectly highlights the nuance you'll need to recognize on the exam. Asking about pregnancy plans. Violation. Requiring the non-borrowing spouse to sign the security instrument in a community property state. Permissible.
Precisely. You need to separate those two actions.
What are some other prohibited practices under ECOA?
Refusing to consider public assistance income reliably received. Assuming a woman of childbearing age will stop working. Refusing to consider reliable pension, annuity, or retirement income. Or refusing to consider regular alimony or child support if the borrower chooses to rely on it for qualifying income. These are all forms of discrimination. ECOA aims to prevent. You have to evaluate the income based on its likelihood of continuance, not its source.
Now, let's clarify what is allowed for consideration regarding creditworthiness so you know where the line is drawn.
Okay, what can creditors look at?
For age and receipt of public assistance income, they can generally only be considered in the applicant's favor. For example, using age to qualify someone for a special program designed for the elderly.
So you can use it to help, but not to hurt.
Right. A creditor may consider the amount and probable continuance of income when evaluating creditworthiness. This is standard underwriting practice. Evaluating income stability is allowed.
Makes sense. What about credit history?
A creditor can consider the credit history of the applicant and their spouse, if applicable, like in community property states, or if relying on spouse's income. Plus, any information the applicant provides to show that the history doesn't accurately reflect their actual creditworthiness, like explanations for past issues.
So they look at the history, but should consider explanations too.
Yes, and interestingly, and this is a common point of discussion, the law, quote, does not prohibit consideration of immigration status when assessing creditworthiness or likelihood of repayment.
So checking if someone has the legal right to reside and work in the country long enough to repay the loan isn't prohibited by EQA.
Correct, though it doesn't mandate it either.
Okay. What about self-testing?
EQA encourages self-testing. This allows creditors to proactively conduct internal reviews, sometimes using testers posing as applicants, to identify potential violations of the law within their own operations.
Why would a lender want to do that? Find their own problems.
Because the information from such tests is protected as privileged if certain conditions are met. Confidentiality must be maintained. They can't use it to defend themselves if sued later. And critically, they must take appropriate corrective action to address any discriminatory acts or practices found.
So if they find a problem and fix it, the self-test results are shielded. That encourages proactive compliance.
Exactly. But it's important to note that these self-test programs must include more than an analysis of loan and application files, such as using testers.
Meaning you can't just audit paperwork. You might need to use paired testing, sending out matched pairs of applicants, differing only on a prohibited basis, to truly test for discrimination in practice.
Right. It ensures a more robust and proactive approach to compliance.
And finally, for ECOA, let's talk penalties for violations.
What's the time frame for someone to sue? The statute of limitations.
It's 5 years from the date on which the alleged violation occurred. That applies to individual lawsuits, class actions, and actions brought by the U.S. Attorney General. 5 years.
5 years. Got it. What about damages?
For punitive damages, which are intended to punish the creditor, Regulation B limits the amounts. It's up to $10,000 for individual actions.
$10 max punitive for individuals. Class actions.
For class actions, punitive damages are limited to the lesser of $500,000 or 1% of a creditor's net worth.
Okay, $500K or 1% net worth, whichever is less.
A court may also award actual damages, compensating the victim for harm, the costs of bringing the action, and reasonable attorney's fees. These penalty amounts are vital for the exam, so be sure to commit them to memory.
Definitely. Know those numbers.
All right, let's transition to another major one. This one focuses on empowering consumers with clear information about the cost of borrowing, the Truth in Lending Act, or TILA.
TILA, Regulation Z. This act is a giant in consumer protection, really focusing on transparency in credit terms and costs.
Indeed. TILA was enacted in 1968 and is Title I of the Consumer Credit Protection Act, CCPA. Regulation Z, found at 12 CFR Section 026.1 at CEQA, is where you'll find its extensive regulations.
Enforcement, still the CFPB.
Primarily, yes. The CFPB is responsible for its implementation and enforcement. Its primary goals, verbatim from our source, are crucial. First, protect consumers by disclosing the costs and terms of credit.
Disclosure of costs and terms.
Second, create uniform standards for stating the cost of credit, thereby encouraging consumers to compare the cost of loans offered by different creditors.
Uniform standards for comparison shopping, like the APR.
Exactly. Third, ensure that advertising for credit is truthful and not misleading.
Truth in advertising.
And fourth, provide borrowers with the right to rescind certain types of mortgage transactions.
And the right to cancel. We'll definitely dig into that.
Absolutely. Those 4 goals capture the essence of TILA.
So what loans are covered by TILA? Are there conditions?
Yes. There are 4 conditions the credit transaction must meet to fall under TILA's purview. 1, the credit is offered to consumers, meaning individuals, not businesses, primarily personal use.
Consumer credit. Okay.
2, the offer or extension of credit is made regularly.
Regularly. Is there a definition for that?
Yes, and here's an important numerical detail for the exam. A person regularly extends consumer credit if the credit is secured by a dwelling and was extended more than 5 times in the preceding calendar year.
More than 5 times a year for dwelling-secured loans.
Or if in any 12-month period, the creditor originates more than 1 credit extension that is a high-cost mortgage regulated under HOEPA.
Ah, so even just one HOEPA loan can trigger the regularly extends definition. Good detail. What are the other 2 conditions?
3, the credit includes a finance charge or a written agreement stating that the loan may be repaid in more than 4 installments.
So either a cost for credit or more than 4 payments.
Right. And 4, the credit is primarily for personal, family, or household purposes.
Personal, family, household. Reinforces the consumer focus. If you think consumer credit, you're usually on the right track for TILA.
Generally, yes.
TILA also has its exemptions, just like RESPA.
It does. TILA does not apply to. Transactions for business, agricultural, or organizational credit, similar to RESPA there.
Okay, business accord credit is out.
Credit in excess of an annually adjusted threshold amount. However, this threshold does not apply to transactions secured by real property or a dwelling.
That's a key exception. So even very large mortgage loans are still covered by TILA.
Correct. That threshold exemption doesn't apply to mortgages. Also exempt. Public utility credit, credit extended by an SEC or CFTC registered broker-dealer, home fuel budget plans, federal student loans, and employment-sponsored retirement plan loans.
So again, generally, if it's not consumer purpose or not secured by a dwelling, with some specific exceptions like student loans, it's probably exempt from TILA.
That's a good rule of thumb.
Moving on to some foundational definitions under TILA that are absolutely crucial for your exam and will likely appear verbatim. First, application. Under TILA, what constitutes an application for a mortgage?
For mortgage credit subject to treated rules, which we'll get to, a complete application consists of these 6 specific pieces of information. Knowing these 6 items is key because receiving them triggers the timeline for providing the loan estimate. The 6 items are the consumer's name, social security number, income, the address of the property to secure the loan, an estimate of the value of the property securing the loan, and the loan amount sought.
Name, SSN, income, property address, estimated value, loan amount. Got it. NIVALS is a common acronym.
Exactly. Now, here's an exam alert for the definition of business day, because TILA has 2 distinct definitions you absolutely need to differentiate for that perfect score.
2 definitions.
Yeah.
Okay, this sounds tricky.
The general definition, which is used for deadlines like providing the loan estimate, is any day on which the creditor's offices are open to the public for carrying out substantially all business functions.
So basically normal operating days for the lender, typically Monday through Friday, excluding public holidays.
Right. But the specific definition used for the closing disclosure waiting period and, critically, the right to rescind is broader. All calendar days except Sundays and legal public holidays.
All calendar days except Sundays and federal holidays. So Saturdays count for rescission and the CD waiting period, even if the lender is closed.
Precisely. That distinction between any day offices are open for LE and all calendar days except Sundays and holidays for CD rescission is often tested. Be absolutely precise with this on your exam.
Very important difference.
Yeah.
Okay, next definition, consummation.
Consummation is the time that a consumer becomes contractually obligated on a credit transaction. It's the point of no return, legally speaking.
So typically closing or settlement.
Yes. For pre-consummation disclosures like the closing disclosure, it's safest to assume consummation is the closing date the moment the borrower signs the loan documents and is legally bound.
Okay. Dwelling. How is that defined?
It's broadly defined as a residential structure that contains 1 to 4 units, whether or not the structure is attached to real property.
1 to 4 units. So a duplex counts.
Yes. It also includes condominium units, cooperative units, mobile homes, or trailers if they're used as a residence. It's not just traditional single-family houses.
Good to know. And finally, for these key definitions, residential mortgage transaction.
This is defined as a transaction in which a mortgage is created or retained in the consumer's principal dwelling to finance the acquisition or initial construction of that dwelling.
Acquisition or initial construction. This definition is crucial as you mentioned, for determining rescission exemptions.
Exactly. Because, as we'll see, these residential mortgage transactions basically purchase money mortgages or loans to build a home, are exempt from the right to rescind. That definition is why.
Okay, that makes sense. Now, TILA established two uniform standards for stating the cost of credit, providing those apples-to-apples comparisons for consumers.
Right. The finance charge, which is the cost of credit as a dollar amount, and the annual percentage rate, APR, which is a measure of the cost of credit expressed as a yearly rate.
Finance charge is the total dollar cost. APR is the yearly percentage cost.
You got it. The finance charge shows the actual dollars you pay to borrow, while the APR converts that, plus other fees, into a standardized yearly percentage, making it easier to compare different loan offers with different fee structures.
Let's break down the finance charge first. Understanding its inclusions and exclusions is vital for the exam. What costs are always included?
It always includes interest over the life of the loan, transaction fees, loan origination fees, points paid by the consumer, like discount points or origination points, credit guarantee insurance premiums, like FHA, MIP usually, and mortgage broker fees, whether paid by borrower or lender. These are core costs directly related to getting the credit.
Okay, always in. Are there things that are included sometimes?
Yes. Premiums for credit life, accident, and health, or loss of income insurance are included unless the insurance is not required by the creditor and the consumer signs or initials an affirmative written request for it after disclosures.
So voluntary credit insurance is excluded if disclosed properly. What about property insurance?
Premiums for property or liability insurance, like hazard insurance, are included unless the consumer can choose their own insurance company and this choice is disclosed.
So if the lender forces you to use their specific insurance company, the premium might be part of the finance charge.
Correct. Also, charges imposed by third parties are included unless their use is not required by the creditor and the creditor doesn't retain the charge. This is where that RESPA markup distinction connects again. If the creditor retains an upcharge on a third-party fee, TILA includes that retained portion in the finance charge.
Ah, okay. Now, what fees are not included if they are bona fide and reasonable for residential mortgages?
Fees not included if bona fide and reasonable are typically your standard closing costs. Fees for title insurance, title examination, property survey, loan document preparation, amounts required to be paid into escrow accounts, notary fees, and appraisal and credit report fees.
These are generally seen as necessary third-party costs for the transaction itself, not direct costs of credit imposed by the lender.
Exactly. And charges never included in the finance charge are charges that would also be paid in a comparable cash transaction, like sales tax, charges for unanticipated late payments or defaults, seller's points, points paid by the seller to help the buyer, and participation or membership fees, unless they're a condition of the credit.
Got it. And there's an accuracy tolerance for the finance charge.
Yes. For closed-end loans, the disclosed finance charge is considered accurate if it is not understated by more than $100, or the amount stated is greater than the amount required to be disclosed.
So they can overstate it, but
Yep.
can't understate it by more than $100. That $100 tolerance is a common exam detail.
Definitely remember the $100.
Now for the annual percentage rate, APR. This gives a fuller picture of loan costs by converting the finance charge, plus some other fees, into a yearly rate.
Right. It reflects the total cost of borrowing on an annual basis.
What fees are generally included in the APR calculation? Is it the same as the finance charge?
Yeah. Mostly similar, yes. Fees generally included in the APR are private mortgage insurance, PMI or mortgage insurance premium, MIP, discount points and origination points, mortgage broker fees, and lender fees like origination, processing, and underwriting fees. Think of costs imposed by the lender or required third parties as part of getting the loan.
And fees generally excluded from the APR.
Again, similar to the finance charge exclusions. Title insurance and examination fees, escrow deposits, notary fees, appraisal and credit report fees, and document preparation fees. These standard closing costs usually aren't factored into the APR.
Okay, now for exam purposes, pay close attention to the accuracy tolerances for the APR for closed-end mortgages. These are specific percentages that you absolutely need to know for that perfect score.
Right. TILA allows a small margin of error for the APR disclosure. For a regular loan one with a single advance and regular payments, the disclosed APR is considered accurate if it is not more than 18 of 1 percentage point above or below the actual calculated APR.
1/8 of 1%. That's 0.125%. Very tight tolerance.
It's very tight. If it's an irregular loan, meaning it has multiple advances, like a construction loan or irregular payment amounts or timing, the tolerance is slightly wider. The APR is accurate if it's not more than 14 of 1 percentage point above or below the actual calculated APR.
0.25%, or 0.25% for irregular loans. These tolerances, 18% for regular, 14% for irregular, are frequently tested because they indicate compliance flexibility. You have to know those fractions.
Absolutely commit those fractions to memory.
All right, now for a critical consumer protection under TILA that often appears on the exam, the right of rescission.
The right to change your mind, essentially.
Yes, it's a legal remedy that voids a contract between two parties, restoring each to the position held prior to the transaction. It's a powerful tool, and it's only available for loans secured by the consumer's principal dwelling.
Principal dwelling is key, not second homes, not investment properties. And what types of loans does it apply to?
This right applies to both open-end credit, like home equity line of credit, HULC, and closed-end credit. Common examples where it does apply are ELOCOMs, refinances of a primary residence with a new lender, and home improvement loans secured by a primary dwelling.
Okay, HAOCs, refis with new lenders, home improvement loans, but there are crucial exemptions you must know for the exam. When does the right to rescind not apply?
No right to rescind exists for a residential mortgage transaction. Remember that definition. A loan to finance the purchase or initial construction of your principal dwelling.
Right. That's why you can't rescind your main home purchase loan 3 days after closing. That's the biggest exemption.
Exactly. Also exempt. A refinancing or consolidation of credit with the same creditor that is already secured by the principal dwelling. Though if you refinance with a different lender, the right usually applies.
Same creditor refi, no rescission, usually. New creditor refi, rescission applies. Got it.
It's also exempt. A lending transaction with a state agency. And an advance, except for the initial advance, in a series of advances under an open-end plan, like subsequent draws on a HELOC after the initial one.
These exemptions are classic exam questions. Know when rescission applies and when it doesn't. Purchase loans and same lender refis are the big ones that are typically exempt.
Our source gives a scenario that really brings this to life.
Let's hear it. Scenarios help.
Kevin Tran takes out a home equity line of credit, HELOC, to finance home renovations. The morning after closing, he suffers an injury and can no longer proceed with the plans, so he decides to cancel the loan. He immediately sends an email to his loan originator stating his wish to rescind.
Okay, HELOC on primary residence. Wants to cancel right after closing.
The takeaway here illustrates the applicability and how simple it is to exercise the right. Kevin's loan qualifies for the 3-business-day right to rescind because it is a HELOC on his primary residence. His simple written notice via email is legally sufficient to effectuate the rescission of the transaction.
So it applies to HELOCs. And just a clear written notice, even an email, is enough. No special form required to rescind. That's important.
Right. Now, for the notice of the right to rescind itself, who gets it and what does it say?
Creditors must provide 2 copies to each party with an ownership interest in the principal dwelling.
2 couples per owner. Why 2?
Presumably so, one can be kept for records, and one can be sent back to the lender if they choose to rescind. The content must be on a separate document, clearly disclose the security interest being taken, explain the right to rescind, provide instructions on how to exercise it, including a form they can use and the lender's business address, state the specific date the rescission period expires, and describe the effects of rescission, like getting fees back.
Okay, 2 copies each, specific content. Now the timing. The 3-business-day right to rescind.
This is intended to give a borrower that crucial cooling-off period, a chance to reconsider a major financial decision, especially one using their home as collateral. The timing is critical for your exam. How long does it last?
It lasts until midnight on the 3rd business day after the last of the following events occurs: consummation of the loan, delivery of the notice of the right to rescind, or delivery of all material disclosures.
The last of those 3 events starts the 3-day clock. Material disclosures include things like the accurate APR, finance charge, total of payments, payment schedule, and any special HOEPA disclosures if applicable.
And remember, for rescission, business day means all calendar days except Sundays and federal holidays.
Crucial reminder, Saturdays count. What happens during that 3-day period? Can the lender give out the money?
No. During the rescission period, No money shall be disbursed other than in escrow, no services shall be performed, and no materials delivered until the rescission period has expired, and the creditor is reasonably satisfied that the consumer has not rescinded.
It essentially freezes the transaction for 3 business days to allow for that change of mind.
Can a borrower ever waive this right?
Yeah.
Speed things up.
Yes, but only for a bona fide financial emergency. This waiver must be in writing. It needs to specifically describe the emergency, and it must be dated and signed by all parties who have the right to rescind.
And critically, mortgage professionals are prohibited from providing any type of pre-printed form for such waivers.
Right. The borrower has to write it out themselves. This ensures it's a genuine, specific, and urgent emergency, not something simply pressured by the lender to close faster. Waivers are rare and scrutinized.
Okay. Now, what if the lender messes up the notice or disclosures? Is there a longer period?
Yes, beyond the initial 3-day period, there's also a 3-year right to rescind. This extended right becomes available if the creditor fails to provide a compliant notice of right to rescind or fails to provide accurate material disclosures, specifically inaccuracies in the APR, finance charge, amount financed, total of payments, or payment schedule.
3 years. That's a
Yeah.
long time.
It is. It's a significant remedy for major disclosure violations. However, this extended right expires upon transfer of all of the consumer's interest in the property, or upon sale of the property, whichever occurs first.
So, if the borrower sells the house or transfers title within those 3 years, the extended right is extinguished.
Correct. It doesn't last forever. There are also specific accuracy tolerances for disclosures that determine if the 3-year right is triggered.
Tolerances again. What are they here?
For the extended right, the disclosed finance charge is generally considered accurate if it's understated by no more than 1% of the face amount of the note, or $100, whichever is greater, or if it's overstated.
0.5% of the loan amount or $100. That's a bit more forgiving than the initial $100 tolerance.
Slightly. However, if the loan is in foreclosure, the tolerance for the finance charge triggering the 3-year right is much tighter. It's considered inaccurate if understated by no more than $35.
Only $35 tolerance in foreclosure situations. Wow. These extended periods and specific tolerances are tricky, so definitely highlight them for your exam prep.
Absolutely. Precision details are prime exam material.
Let's talk about advertising under TILA's Regulation Z. Truthful advertising is a major goal, designed to prevent bait-and-switch tactics.
Makes sense. Truth in lending should mean truth in advertising, too.
The general rule is straightforward. If an advertisement for credit states specific credit terms, it shall state only those terms that actually are or will be arranged or offered by the creditor. And all required disclosures and ads must be made clearly and conspicuously so consumers aren't misled.
No fine print that contradicts the headline.
Exactly. Now, for closed-end loans, like typical mortgages, there are specific trigger terms you must memorize. If any of these terms are used in an advertisement, they automatically trigger the requirement to include additional specific disclosures in that same ad.
Okay, trigger terms. What are they? This sounds important.
The trigger terms are amount or percentage of any down payment, e.g. 10% down, number of payments or the period of repayment, for example, 30-year loan or 360 payments, payment amounts, e.g. payments as low as $800 a month, and the finance charge. For example, financing costs less than $1,000.
Down payment, number period of payments, payment amount, finance charge, if you state any of those specifics.
Then the advertisement must also clearly and conspicuously state these 3 things: the amount or percentage of the down payment, the terms of repayment over the full term of the loan, and the APR and whether the rate may increase after consummation.
So if you advertise one attractive number, like a low payment, you have to show the other key terms too, like the down payment, the full repayment term, and critically, the APR. It ensures consumers get a more complete picture, not just the teaser rate.
Exactly. It prevents misleading snapshots. Regulation Z also lists 7 key advertising prohibitions for closed-end credit, designed to prevent specifically deceptive practices.
What kind of practices are prohibited?
Misleading advertising of fixed rates and payments when they aren't truly fixed for the whole term, misleading comparisons between different loan products or payments, misrepresentations implying a government endorsement of the loan, misleading use of the consumer's current lender's name to imply affiliation, misleading use of the word counselor if the advertiser isn't a nonprofit counselor, and misleading use of foreign language in advertisements that might imply different terms than those actually offered.
These are all about protecting consumers from being tricked by slick advertising into loans that aren't what they seem. Common sense, but codified in the rules.
Shifting gears slightly to TILA record retention. Knowing these specific periods is crucial for the exam, as retention periods are frequently tested across different regulations.
Okay, how long do lenders need to keep TILA records? Does it vary?
It does. Creditors must retain evidence of compliance with loan estimate requirements for at least 3 years after consummation, the date on which disclosures are required to be made, or the date on which action is required to be taken, whichever occurs later.
3 years for the loan estimate records. Got it.
For closing disclosure compliance records, the retention period is longer, at least 5 years after consummation.
5 years for the closing disclosure. Why longer?
Likely because the CD represents the final terms and costs of the actual transaction, making it more critical for potential disputes or audits down the road.
Makes sense. What about other TILA areas?
Specifically for low compensation records, they must be kept for at least 3 years after each receipt of payment to the loan originator. And records related to demonstrating compliance with the ability to repay requirements must be kept for at least 3 years after consummation.
So mostly 3 years, but 5 years for the closing disclosure. These varying retention periods, 3 for LE, low comp, ATR, 5 for CD, are definitely something to commit to memory for your perfect score.
Absolutely. Now, for the penalties for violations of TILA, what are the consequences?
There can be both criminal and civil liability. Criminal liability can arise from willful and knowing violations of TILA.
Willful and knowing, so intentional wrongdoing.
Yes. Penalties can include fines of up to $5,000, imprisonment for up to 1 year, or both. So intent matters for criminal charges.
What about civil liability for violations, even if not willful?
In individual actions brought by consumers, potential penalties include actual damages suffered by the consumer, statutory damages equal to twice the amount of any finance charge, within certain limits, additional monetary penalties set by law, court costs, and reasonable attorney's fees.
Twice the finance charge. That could be substantial.
It can be. For closed-end loans secured by a dwelling, the statutory penalty specifically has a floor and ceiling. No less than $400 and no more than $4,000 per violation in an individual action.
$400 minimum, $4,000 maximum statutory penalty for individual mortgage violations. Good numbers to know for the exam.
Definitely. In class actions, the total recovery for statutory damages is limited to $1 million or 1% of the creditor's net worth, whichever is less, plus actual damages, costs, and attorney fees.
Okay, caps on class actions again. Is there any defense for lenders if they make a mistake?
Yes, there is a bona fide error defense. A creditor may not be held liable for a TILA violation if they can show by a preponderance of evidence that the violation was unintentional and resulted from a bona fide error, notwithstanding the maintenance of procedures reasonably adapted to avoid any such error.
So if a lender has strong compliance procedures in place designed to prevent errors and an accidental, unintentional slip-up still occurs, they might be protected. That's a key concept.
It is. It incentivizes having robust compliance systems.
Now let's go even deeper within TILA to some specific, frequently tested sections that were added over time. HOEPA, HPML, low compensation, and TRIDE. These are often tested together or in relation to the broader TILA rules.
Right. These are major amendments or related rules under the TILA umbrella, very important for the current SAFE exam.
We'll start with the Home Ownership and Equity Protection Act, or HOEPA. This governs high-cost mortgages, often referred to as Section 32 loans.
HOEPA, Section 32. This was enacted first back in 1994, marking the federal government's first direct attempt to address predatory lending practices, specifically in the high-cost mortgage market.
What kind of practices was it targeting?
It creates specific protections under TILA for loans with excessively high interest rates and/or high fees. Its purpose is really to combat predatory lending tactics like equity stripping and reverse redlining, where vulnerable homeowners, often elderly or minority borrowers, were targeted with unfair, unaffordable loan terms that put their homes at risk.
Who enforces HOEPA?
The CFPB enforces HOEPA, and its specific regulations are found in Sections 31, 32, and 34 of Regulation Z. Its scope was also expanded significantly by the Dodd-Frank Act after the 2008 crisis.
How was it expanded?
Originally, HOEPA focused mainly on refinances and home equity loans. Dodd-Frank expanded its coverage to include home purchase loans and home construction loans, as well as open-end home equity lines of credit, ACLOs, not just closed-end loans, so its reach is much broader now.
Are there any loans exempt from HOEPA?
Yes, there are specific exemptions, which are good to know for the exam. Reverse mortgage loans have their own rules. Bridge loans used solely to finance the initial construction of a dwelling. Those temporary construction loans again. Loans originated and financed by a housing finance agency, HFA, where the HFA is the creditor, and loans originated under the USDA's Rural Housing Service, RHS, program.
So these specific, often government-backed or temporary loans are outside HOEPA's specific high-cost rules.
Correct. Now, defining what constitutes a high-cost mortgage is absolutely crucial for the exam. It involves very specific numerical thresholds. If a loan meets any of these, it's a HOEPA loan and subject to stricter rules and prohibitions.
Okay, lay out the triggers. How does a loan become high cost?
A loan is high cost if it's secured by the borrower's principal dwelling and not one of those exempt types like a reverse mortgage, and meets one of these three triggers. First,
Yeah.
the APR threshold.
Okay, based on the annual percentage rate.
For first lien mortgages, the threshold is triggered if the APR at consummation is more than 6.5 percentage points above the average prime offer rate, APR, for a comparable transaction.
6.5 points over APR for first liens. What about second mortgages?
For subordinate lien mortgages, the threshold is lower. It's triggered if the APR is more than 8.5 percentage points above the APR.
8.5 points over APR for subordinate liens.
Yeah.
Got it. What's the second trigger?
The second trigger is the points and fees threshold. This one varies by the loan amount, and these dollar figures adjust annually, so focus on the percentages and the logic. For loans of $26,968 or more, using the 2025 example figure from the outline, the threshold is triggered if the total points and fees paid by the consumer exceed 5% of the total loan amount.
5% of the loan amount in points and fees for larger loans. What about smaller loans?
For smaller loans of less than $26,968, the threshold is triggered if points and fees exceed the lesser of 8% of the total loan amount, or $1,348, again, using the example figure.
So 8%? Or a specific dollar amount, whichever is lower, for small loans. That's complex but important. What fees count towards this?
It's a broad definition of points and fees, including origination fees, broker fees, points, and even some closing costs that aren't usually in the finance charge, like some third-party fees if the creditor requires them. You need to know the specific list for the exam.
Okay, and the third trigger?
The third trigger is the prepayment penalty threshold. A loan is high cost if it has a prepayment penalty that is enforced for more than 36 months, 3 years, after consummation, or if the penalty amount can exceed 2% of the amount prepaid.
Prepayment penalty lasting more than 3 years or exceeding 2% of the amount paid early.
Correct. Memorize these numbers and percentages. APR thresholds, 6.58.5 over APOR. Points and fees thresholds, 5% or 8%, or 8%, $1,348. Prepayment penalty thresholds, 36 months, 2%. If any of these three conditions are met, you have a high-cost mortgage, a Section 32 loan, and a whole set of extra protections and restrictions kick in.
Extremely important to know those triggers cold. Now, next up, we have higher-priced mortgage loans, or HPMLs, often called Section 35 loans.
HPMLs, Section 35.
And it's a critical exam point that HPMLs and high-cost mortgage loans are not the same.
Absolutely vital distinction. They sound similar. They both relate to rates being higher than average, but their specific trigger thresholds are different, and the protections or requirements they trigger are also different. Don't confuse HOEPA, Section 32, with HPML, Section 35.
Okay, so how is an HPML defined?
HPLs are defined as closed-end loans that are secured by a borrower's principal dwelling and that exceed the average prime offer rate, APR, for a comparable transaction by a smaller margin than HOEP loans. Specifically, the APR exceeds APR by 1.5 percentage points or more for conforming first lien loans, your standard mortgage within Fannie-Freddie limits.
1.5 points over APR for conforming first loans.
2.5 percentage points or more for jumbo first lien loans, where the principal amount is above the conforming loan limit.
2.5 points over APR for jumbos.
Or 3.5 percentage points or more for subordinate liens loans.
3.5 points over APR for subordinate liens. Okay, so these thresholds, 1.5, 2.5, 3.5, are lower than the HEPA thresholds, 6.5, 8.5. This means a loan could be an HPML without being a high-cost HEPA loan.
Exactly. HPML is a broader category covering moderately higher price loans, while HEPA covers the highest cost loans. The rate used for determining these HPML thresholds is the APR as of the date the interest rate is set or locked for the transaction. HPMLs trigger specific requirements like mandatory escrow accounts and special appraisal rules, which are different from HEPA's restrictions.
Good distinction. So know both sets of thresholds. Now let's discuss the loan originator LO compensation rule found at 12 CFR section 1026.36 within Regulation Z.
A low comp. a very important rule also stemming from Dodd-Frank.
What was its purpose?
This rule was issued by the CFPB specifically to discourage harmful practices by loan originators. Primarily, it aims to prevent LOs from having incentives to steer borrowers into more expensive loans, like loans with higher interest rates or fees, just so the LO can earn a higher commission. It's about aligning the LO's interests more with the borrowers.
How does it define a loan originator? Is it just the person taking the application?
No, it's defined very broadly. Our source lists the activities that make someone an LO under this rule. It includes anyone who, for compensation or gain, performs any of these activities, takes an application, assists a consumer in applying for a loan, negotiates and obtains credit for a consumer, offers or negotiates credit terms, or advertises or communicates to the public an ability or intent to engage in any of the above-listed activities.
Wow, that's a wide net. Even just advertising an intent to negotiate terms makes you an LO for this rule's purpose.
Yes, it covers a lot of ground. The rule primarily discourages three types of practices: basing low compensation directly on the loan terms, like the interest rate or points, allowing dual compensation, where the LO gets paid by both the borrower and the lender or another party for the same transaction, and creating incentives for steering consumers towards specific, often more expensive loan products that aren't in the consumer's best interest.
What counts as compensation under this rule? Just commission?
No, again, it's very broad. It includes salaries, commissions, and any other financial or similar incentives. Our source mentions it can include things like bonuses, awards, services, trips, and other benefits. It's designed to capture any form of payment or perk that could potentially influence an LO's actions regarding loan terms.
Okay, now this is a highly tested area for the SAFE exam. Permissible compensation methods. If you can't base pay on loan terms, how can LOs be paid?
Right. The rule doesn't say LOs can't be paid well, just that the structure can't incentivize bad behavior. Our source explicitly lists 7 specific methods that are generally allowed for compensating LOs. Knowing these specific examples is crucial. Compensation can be based on 1. The loan originator's overall dollar volume, for example, total loans closed. 2. The long-term performance of the originator's loans, for example, rewarding loan quality, not just quantity. 3. An hourly rate that is based on the actual number of hours worked. 4. Loans that are made to new customers versus existing customers. 5. A payment fixed in advance for each loan that the originator arranges for the creditor, for example, a flat fee per file. 6. The percentage of the loan originator's applications that close, a pull-through rate. 7. The quality of the loan originator's loan files, for example, based on completeness or accuracy.
That list is key. So paying based on overall volume is okay, but not based on the interest rate of a specific loan.
Exactly. That's the core distinction. Now for the specific compensation prohibitions and limitations. First, the big one. Compensation cannot be based on the terms of a loan. This prevents LOs from directly earning more for putting someone into a higher rate loan or charging more points.
Is there any nuance there?
Yes, a critical nuance for the exam. The rule states that the amount of credit extended, the loan amount, is not considered a transaction term if the LO's compensation is based on a fixed percentage of that amount.
Ah, so an LO can be paid, say, 1% of the final loan amount. That's permissible because it's based on loan size, not the rate or other terms.
Correct. That's a very common and permissible structure. Second prohibition, dual compensation. The rule states that a loan originator that receives compensation directly from a consumer may not receive compensation from another person, like the creditor or broker, in connection with the same transaction, if that other person knows about the consumer-paid compensation.
Prevents double dipping on the same loan. Choose one source of payment, borrower or lender employer.
Precisely. And third, the prohibition against steering. An LO may not direct or steer a consumer to consummate a transaction based on the fact that the originator will receive greater compensation in that transaction unless the transaction is in the consumer's best interest.
So you can't push loan A over loan B just because you make more on loan A. Unless loan A is actually better for the borrower, how do they determine if it's not steering?
The rule provides a safe harbor. Steering is generally considered not to have occurred if certain criteria are met when presenting options. The LO must present the consumer with loan options for which the consumer likely qualifies for each type of transaction requested. These options must come from a significant number of creditors the LO works with, and if offering more than 3 loans, the LO must highlight the options available from the creditors they regularly do business with.
So offering a range of legitimate options the consumer qualifies for is the key to avoiding steering allegations.
Essentially, yes. It prevents an LO from hiding better options just to push the one that pays them more. Our source gives a great scenario for this rule, which clarifies its practical application for your exam.
Let's hear it. LO comp scenarios are common.
Caroline, an MLO with CGE mortgage, receives compensation from her employer, CGE, which collects its fees from the borrower. The amount Caroline receives is the same for each transaction, regardless of the loan terms. Her contract also provides a quarterly bonus if she meets a specific monthly origination volume goal.
Okay, salary commission is fixed per loan, bonus based on volume. Is this okay?
The takeaway is that this compensation arrangement is compliant with the loan originator compensation rule. She is not receiving prohibited dual compensation. She's paid by her employer CGE, who is paid by the borrower, that's okay, and her pay is not based on the loan terms themselves. Furthermore, a bonus program based on the total dollar volume of loans originated is a permissible method of compensation under the rule.
That scenario perfectly illustrates how the rule works in practice. Fixed pay per loan and volume bonuses are generally fine. Pay varying with the rate is not.
Exactly. It's a clear example.
We're moving into another major area for the exam, one that touches both TILA and RESPA. The TILA-RESPA Integrated Disclosure TRIDE rule.
TRIDE, know before you owe. This is all about the loan estimate, LE, and the closing disclosure CD forms.
Right. This rule, implemented in 2015, was a huge change, designed to simplify and standardize the key mortgage disclosures for consumers, making them easier to understand and compare. It essentially combined earlier, separate TILA and RESPA disclosure requirements into two main forms.
The loan estimate is the initial disclosure, provided early in the process to help consumers compare costs and shop competitively. It's your upfront snapshot of the estimated costs and terms.
And the closing disclosure is given prior to closing, helping borrowers understand the final costs and terms of the transaction before they sign on the dotted line.
These two forms replace the old good faith estimate, GFE, the early and final TIL disclosures, and the HUD-1 settlement statement for most transactions. The GFE and HUD-1 are now only used for very limited transaction types not covered by TRIDE. This integration was a massive shift for the industry.
Are there loans not covered by TRIDE, where you'd still use the old forms?
Yes. Important for the exam, TRIDE does not apply to ELOIS, reverse mortgages, or mortgages secured by a mobile home or a dwelling that is not attached to real property, like land. Those still use the older GFE HUD-1 and TIL disclosure processes.
Good exemptions to know. What about record retention for TRIDE?
We touched on this under TILA, but let's reiterate as it's crucial for the exam. Creditors must keep LE compliance records for at least 3 years after the later of consummation, the date disclosures were required, or the date action was required.
3 years for LE records.
And CD compliance records must be kept for at least 5 years after consummation.
5 years for CD records. Remember those specific TRIDE timeframes? 3 for LE, 5 for CD for your exam?
Definitely. General requirements for these integrated disclosures include using the standard model forms provided by the CFPB, leaving blank spaces for non-applicable items, generally estimating costs by rounding to the nearest whole dollar, with some specific exceptions like per diem interest, and disclosing percentage amounts using up to 3 decimal places for accuracy. The goal is clarity and consistency across lenders.
Okay, let's focus on the loan estimate, LE, itself. The timing here is critical for the exam. When must the LE be provided?
It must be delivered directly or placed in the mail no more than 3 business days after receipt of the consumer's application. Remember those 6 pieces of info define the application date.
3 business days after application to get it out the door. Is there a deadline relative to closing?
Yes. It must also be delivered or mailed no later than 7 business days prior to consummation.
So, a lender has 3 days to get it to you after application, and you, the borrower, must have it in hand at least 7 business days before you can close. And which definition of business day applies here?
For both the 3-day LE delivery and the 7-day pre-closing window, it's the general definition. Days the creditor's offices are open for substantially all business.
Okay, mon-free excluding holidays, generally. What if it's mailed?
If the LE is mailed, it's considered received by the consumer 3 business days after mailing, under the mailbox rule. So lenders need to mail it early enough to account for that delivery time to meet the 7-day deadline.
Can consumers waive that 7-day waiting period before closing?
Yes, but again, only for a documented, bona fide personal financial emergency. It requires a specific written statement from the consumer describing the emergency. It's very rare.
What about fees? Can lenders charge fees before the LE is given?
There are strict fee restrictions. A creditor or any other person cannot collect any fees from the consumer before the consumer has received the loan estimate and indicated their intent to proceed with the transaction.
No fees at all before LE received and intent given, not even for an appraisal.
No. The only exception is that a creditor can collect a bona fide, reasonable fee to obtain the consumer's credit report before providing the LE. That's it. No application fees, appraisal fees, nothing else until after the LE is received and the consumer says, yes, I want to move forward.
That's a significant protection. The creditor must also retain documentation proving the consumer's intent to proceed for at least 3 years.
Now, pay very close attention to good faith estimate and tolerances on the LE because this is an exam focus. This determines how much the actual fees charged on the closing disclosure can differ from the estimates on the loan estimate.
Right, the estimates have to be made in good faith. How much can they change?
There are 3 categories of tolerance. First, zero tolerance. This means certain fees disclosed on the LE cannot increase at all on the CD.
Cannot change, period. Which fees fall here?
This applies to fees paid to the creditor, the mortgage broker, or an affiliate of either. It also applies to fees paid to an unaffiliated third party if the creditor did not permit the consumer to shop for that service provider. And finally, transfer taxes always have zero tolerance. These simply cannot increase.
Okay, fees to lender, broker, affiliate, fees for services you can't shop for, and transfer taxes. You have zero tolerance. What's next?
Second category, 10% cumulative tolerance. This means the aggregate amount of certain charges cannot increase by more than 10% from the total estimated for that category on the LE.
Aggregate meaning the sum of those fees? Which ones are in this bucket?
This bucket typically includes recording fees paid to government agencies and charges for third-party services where the creditor did permit the consumer to shop from a list of approved providers, but the consumer chose one from that list or didn't choose one at all.
So recording fees and fees for services you can shop for from the lender's list if you pick from their list. The total for all these can't go up by more than 10% combined.
Correct. It's a cumulative cap for that group of fees.
And the third category?
Third is unlimited tolerance, or no tolerance limit. These charges may vary from the estimate on the LE without any specific percentage restriction, though they still must be estimated in good faith based on the best information available.
Which fees can vary freely?
These include prepaid interest, per diem interest, property insurance premiums, since the consumer chooses the policy, amounts placed into an escrow account, as taxes insurance can change, charges paid to third-party service providers that the consumer specifically selected not from the creditor's list, and charges paid for third-party services not required by the creditor at all, like an optional owner's title policy or home warranty.
Understanding which category each fee falls into 0, 10% cumulative, or unlimited is absolutely crucial for nailing Caridi questions on your exam.
Couldn't agree more. Tolerance questions are very common.
Now, can the loan estimate ever be revised?
Yeah.
Can the lender issue a new LE with different numbers?
Yes, but only under specific circumstances. This is called issuing a revised loan estimate. The timing for issuing a revised LE is generally within 3 business days of receiving the information that prompted the change.
Okay, 3 days after learning of the change. Is there a deadline before closing?
Yes. The consumer must receive the revised LE no later than 4 business days prior to consummation. This ensures they have time to review the changes before the final CD comes out. Remember, this uses the general business day definition.
4 business days before closing for the revised LE receipt. Now, what are the valid reasons for a revised LE? This is key to know for the exam, as these are frequently tested scenarios. You can't just revise it anytime.
Correct. The valid reasons, often called changed circumstances or similar triggers, include an actual rate lock after the initial LE was issued, if the rate wasn't locked initially. A revised LE showing the locked rate is due no later than 3 business days after the date on which the rate is locked. This is a very common reason. A valid changed circumstance affecting settlement charges, eligibility, or the value of the property. This includes things like extraordinary or unexpected events, discovering inaccurate info the creditor relied on, or receiving new info specific to the consumer or transaction. A change in eligibility. Information arises that affects the consumer's creditworthiness or the value of the property, impacting the loan terms or product availability. Consumer requested revisions. The borrower asked to change something, like the loan amount, the loan product, or decides not to lock the rate when the LE assumed it was locked. Delays caused by the consumer. If the applicant waits more than 10 business days after the LE is provided before indicating their intent to proceed, the creditor can issue a revised LE. Delays related to construction loans. If settlement is expected to occur more than 60 days after the initial LE was provided, common with new construction, a revised LE reflecting updated costs can be issued.
Knowing that list of valid reasons is critical. You can't revise the LE just because you underestimated a fee that had zero tolerance initially.
Exactly. It has to be one of these specific triggering events.
Briefly, what's the content layout of the loan estimate?
Page 1 gives you the quick overview, general transaction info, the core loan terms, amount, rate, payment, a summary of the estimated projected payments over time, including taxes insurance if known, and a snapshot of the estimated cash needed at closing. It's designed for quick comparison.
Page 1 is the summary.
Page 2 provides the detailed breakdown, the closing cost details. It itemizes all the loan costs and other costs, separating them into categories like origination charges, services you cannot shop for, services you can shop for, taxes, gov fees, prepaids, escrows, etc. This is where the tolerance categories become clear.
Page 2 is the itemized list.
Page 3 includes contact information for the creditor and loan originator. The comparisons table, showing key metrics like total paid in 5 years, APR, and tip total interest percentage, and the other considerations table, which covers important details like appraisal, assumption policy, homeowners insurance, late payment policy, refinancing implications, servicing intentions, and escrow details.
Page 3 is comparisons and other important details. Got it. Now for the closing disclosure, CD.
The final act before closing.
Its timing is also critical for the exam, and it's a major point of consumer protection. When must the borrower receive the CD?
The CD must be received by the consumer no later than 3 business days prior to consummation.
Receive 3 business days before signing. And which business day definition is this?
This uses the specific definition, all calendar days except Sundays and legal public holidays. So Saturdays count towards this 3-day waiting period.
Okay, 3 rescission business days before closing to review the final numbers. What if it's mailed?
If mailed, it's presumed received 3 business days after placed in the mail. So lenders have to mail it about a week before closing to be safe.
Can this 3-day waiting period be waived?
Again, only for that documented, bona fide personal financial emergency with a written waiver from the consumer. Extremely rare.
Now pay special attention here. Changes requiring a new waiting period. If certain significant changes occur after the initial CD is delivered but before consummation, the creditor must provide a revised CD and a new full 3 business day waiting period must start all over again.
A new 3-day clock. Which changes trigger this? This sounds highly testable.
There are only 3 specific changes that trigger a new 3-day waiting period. Memorize these. They are: 1, a change in the annual percentage rate, APR, beyond the established accuracy tolerances, that 18 or 14%. Even a tiny change outside tolerance can trigger it. 2, a change in the loan product. For example, switching from a fixed rate to an adjustable rate mortgage or vice versa. 3, the addition of a prepayment penalty to the loan that wasn't previously disclosed.
APR change, outside tolerance, loan product change, or adding a prepayment penalty. Only those 3 require a brand new 3-day wait. Other changes might require a revised CD, but not necessarily restart the clock. That's a critical distinction.
Absolutely critical. What about correcting errors on the CD?
If a CD becomes inaccurate prior to consummation, maybe due to a last-minute change that doesn't trigger the new 3-day wait, the creditor must provide a corrected disclosure containing the updated terms at or before consummation. The consumer has the right to inspect it 1 business day before closing.
What about errors discovered after closing, post-consummation?
Because errors are discovered after consummation that cause the disclosures to be inaccurate, the creditor generally has a 30-day deadline from discovering the error to provide a corrected CD.
30 days to fix post-closing errors. What if it's a tolerance violation, like they overcharge the borrower?
For tolerance cures, if the consumer was charged more than allowed by the tolerance rules, 0 or 10% cumulative, the creditor must refund the excess amount within 60 days of consummation and provide a corrected CD showing that refund also within 60 days after consummation.
60 days to refund tolerance violations and send proof. Good to know. What about simple typos?
Even for non-numerical clerical errors discovered after closing, a corrected CD must be mailed or delivered no later than 60 days after consummation.
Okay, 60 days seems to be the magic number for post-closing corrections and refunds. Finally, the content of the closing disclosure. Does it mirror the LE?
It's similar in layout but contains the final numbers. Page 1 lists general info, the final loan terms, projected payments, and costs at closing totals. Very similar to the LE page 1, but with final figures.
Page 2.
Page 2 details the final loan costs and other costs, again itemized similarly to the LE, but critically, it often includes columns showing who paid what, borrower, seller, lender credits, etc.
Page 3.
Page 3 features the calculating cash to close table, which explicitly compares the final figures to the loan estimates and explains any changes. It also includes the summaries of transactions table, showing the borrower's side and seller's side of the deal, debits and credits.
Page 4.
Page 4 contains additional loan disclosures required by TILA, such as the assumption policy, demand feature, late payment details, negative amortization possibility, partial payment policy, and details about the escrow account, if applicable.
And page 5.
Page 5 includes the final loan calculations table, showing total of payments, finance charge, amount financed, APR, and tip total interest percentage. Other disclosures like the right to receive appraisal copies and foreclosure information, contact info for all parties, and an optional signature line for the consumer to acknowledge receipt, though signing doesn't mean acceptance of the loan.
Okay. And a key calculation often tested, found on page 5, is the amount financed. What's the formula again?
Our source gives the verbatim formula: principal loan amount plus any financed items like finance PMI, prepaid finance charges, amount financed. This shows the net amount of credit the borrower actually receives after accounting for those upfront finance charges paid at or before closing.
Good formula to know.
Absolutely.
Let's move on to the Homeowners Protection Act, or HPA. This act is relatively straightforward compared to TILA or RESPA, but its details are important for the exam, especially regarding the cancellation of private mortgage insurance, or PMI.
HPA PMI cancellation. This is all about empowering borrowers to get rid of that extra PMI cost once they've built enough equity in their homes.
When was it passed and what does it apply to?
The HPA was passed by Congress in 1998 to facilitate the cancellation of PMI. Its provisions apply to residential mortgage transactions consummated on or after July 29, 1999. It generally applies to conventional residential mortgages secured by a single-family home used as the borrower's principal dwelling, where PMI was required at closing.
Single-family, principal dwelling, conventional loans with PMI. Are there exemptions? Where does HPA not apply? This sounds like a common exam question area.
Yes, there are important exemptions the HPA does not apply to. Government-insured FHA or VA loans, these have their own separate rules for mortgage insurance premiums, MIP, or funding fees.
Okay. FHA VA loans are out. Anything else?
Also exempt are loans protected by PMI that is paid for by the lender, often called LPMI, or lender-paid mortgage insurance. HPA only applies when the borrower is paying the PMI premium directly.
Good distinction. Borrower paid PMI only. Let's put in some key definitions under HPA, and precision matters here for the exam. First, original value.
Original value is defined as the lesser of the sales price of the home or the appraised value of the home at the time of the loan's consummation.
Lesser of sales price or initial appraisal. This is critical for calculating the loan-to-value LTV ratio needed for cancellation. What's the cancellation date?
Cancellation date is defined as either the date on which the loan's amortization schedule shows that the principal balance will reach 80% of the original value of the home, or the date that actual payments reduce the principal balance to 80% of the original value of the home.
So 80% LTV, either based on the schedule or actual faster payments. Then there's the termination date. How is that different?
The termination date is generally later. It's defined as the date that the principal balance is scheduled to reach 78% of the original value of the home, based solely on the initial amortization schedule.
78% LTV, based on the original schedule.
Yeah.
Another key definition for the exam is good payment history. What does that mean under HPA?
A borrower has a good payment history if they meet two conditions related to the timing of the 80% LTV cancellation date. First, they did not make a mortgage payment that was 60 days or more past due during the 12-month period beginning 24 months before the cancellation date.
No 60-plus day lates in the second year prior.
And second, they did not make a mortgage payment that was 30 days or longer past due during the 12-month period preceding the cancellation date.
No 30-plus day lates in the year immediately prior. Got it. Both conditions must be met.
Correct. Finally, midpoint of amortization period. This is simply halfway between the first day of a loan's amortization period and the completion of the time period for amortization to occur. For a 30-year loan, it's the 15-year mark. Understanding these precise definitions is foundational for knowing when PMI can be removed.
Now, let's look at the three distinct ways PMI ends, which is crucial for the exam. Cancellation at borrower's request, automatic termination, and final termination. Let's start with borrower-requested cancellation.
Okay. Cancellation at the borrower's request can happen once the loan reaches the cancellation date, that 80% LTV mark we defined. But hitting 80% LTV isn't enough. The borrower has to meet several requirements.
What are the requirements for borrower-requested cancellation at 80% LTV?
They must submit a written request to the servicer. They must have that good payment history we just defined. They must be current on their payments at the time of the request. They must satisfy the lender's requirements for showing that the home's value has not fallen below its original value. This often requires a new appraisal at the borrower's expense. And they must certify that there are no subordinate liens, like a second mortgage or HEOC, on the property.
So several hoops to jump through. Written request, good payment history, current payments, proof of value, no other liens.
Exactly. A scenario from our source illustrates this. Joseph and Mariah Gutierrez are diligent savers and frequently make mortgage payments larger than the amount owed. After a few years, they successfully pay down their loan balance to an 80% loan-to-value LTV ratio and submit a written request to their servicer for cancellation of their private mortgage insurance, PMI.
Okay, they hit 80% LTV early and asked in writing. What's the outcome?
The takeaway is, under the Homeowners Protection Act, the couple is eligible to request cancellation of PMI because they have reached 80% LTV. The lender will consider their request based on factors such as their payment history and proof of value, etc. Even if the lender denies the request may be due to bad payment history or fall in value, the PMI must still be automatically terminated once the LTV is scheduled to reach 78%.
That brings us to the second way. Automatic termination.
Right. This occurs automatically on the termination date, the date the loan balance is scheduled to reach 78% LTV based on the original amortization schedule. This happens if the borrower is current on their payments on that date.
So at 78% LTV based on schedule, if you're current, PMI drops off automatically. No request needed from the borrower.
Correct. It's the servicer's responsibility to terminate it then.
And then there's final termination. When does that happen?
Right. This is the ultimate backstop. If PMI hasn't been canceled by request or terminated automatically at 78% LTV, it must be terminated at the midpoint of the amortization period of the loan, provided the borrower is current on their payments at that time.
So for a 30-year loan, at the 15-year mark, PMI must end regardless of LTV as long as the borrower is current. That's the absolute latest PMI can ever be charged.
Exactly. It provides a definitive end date.
What about disclosures required by HPA? Does the borrower get notified about these rights?
Yes. For fixed-rate mortgages subject to HPA, the lender must provide specific written disclosures at closing, an initial amortization schedule, notice of the right to request cancellation at the cancellation date, 80% LTV, notice of the ability to accelerate payments to reach that date faster, notice that PMI will automatically terminate on the termination date, 78% LTV, and the actual termination date based on the schedule.
So upfront notice of all the key dates and rights. Are there ongoing reminders?
Yes, servicers must also provide annual disclosures in writing that remind borrowers of their PMI cancellation and termination rights and provide an address and phone number to contact the servicer.
And when PMI actually ends?
A final notification of cancellation or termination indicating that PMI is no longer required and no further premiums are due must be sent to the borrower within 30 days after the actual cancellation or termination date. These disclosures ensure borrowers are consistently aware of their rights and when PMI finally ends.
Okay. Finally, for HPA, prohibited practices and penalties. What can't servicers do?
The receipt of any payments or premiums for PMI more than 30 days after the date of termination or cancellation is explicitly prohibited. They have to stop collecting it promptly.
Stop collecting within 30 days. What if they already collected an unearned premium?
Any unearned PMI premiums must be returned to the borrower within 45 days after the cancellation or termination of PMI.
45 days to refund unearned premiums. Got it. What are the penalties for violating HPA?
For penalties and individual actions brought by borrowers, they may include actual damages, interest on actual damages, statutory damages, not to exceed $2,000, cost of filing the action, and reasonable attorney's fees.
Up to $2 CALers in statutory damages plus actual damages and costs. What's the time limit to sue?
The statute of limitations for filing an HPA action is 2 years from the date of discovering a violation.
2 years from discovery. Okay, that wraps up HPA.
Straightforward, but know those LTV percentages, 80% and 78%, the termination conditions, and the disclosure frontier timelines.
Let's move on to the SAFE Act, the Secure and Fair Enforcement for Mortgage Licensing Act. This act is the bedrock for how loan originators are regulated across the country, ensuring minimum standards and accountability. It's absolutely fundamental for your exam and obviously for your career as an LO.
Yes, the SAFE Act is actually Title V of a larger law, the Housing and Economic Recovery Act of 2008, HERA. It was passed in the wake of the 2008 financial crisis, largely in response to issues with unregulated or poorly regulated loan originators.
What were its main goals?
Its core goals are establishing a nationwide licensing database and education standards for the mortgage industry, aiming to enhance consumer protection and reduce fraud by increasing accountability and tracking of LOs.
And who's in charge? The CFPB again?
Yes, the CFPB is responsible for its implementation and enforcement at the federal level. The specific regulations are split. Regulation G applies to employees of depository institutions like federally regulated banks and credit unions. Regulation H applies to non-depository institutions like independent mortgage companies and their employees.
Regulation G for banks, Regulation H for non-banks.
Right.
And the nationwide database.
Critically, the Act required the creation of and mandates participation by each state in the nationwide multi-state licensing system, NMLS, often called the NML-SNR registry. This creates a central system for licensing and registering LOs.
This leads us directly to licensing and registration requirements, a key distinction for the exam that often confuses test takers. Who needs to be licensed versus just registered?
Right. Loan originators employed by depository institutions, those banks and credit unions regulated by federal banking agencies and covered under Regulation G, are required to register with the NMLS. They get an NMLS ID number, but they don't typically need a state license.
Banks register. What about non-banks?
Loan originators employed by non-depository institutions, such as state-licensed mortgage lenders, brokers, and servicers covered under Regulation H, are required to become licensed through the NMLS in each state where they conduct business. This involves meeting stricter state requirements beyond just registration.
Okay, remember that difference. Banks register, state-licensed companies license. Crucial distinction.
Absolutely. Now, this next section on minimum licensing standards under the RAFE Act is core for your SAFE exam. You need to know these requirements like the back of your hand to ensure that perfect score, as they appear frequently in various forms.
Okay, minimum standards to get a state LO license, what are they?
To get a state license, an applicant must demonstrate that they meet several key standards. First, regarding past license issues, they must have never had a loan originator license revoked in any governmental jurisdiction. However, the source notes, a revocation that has been vacated will not be deemed a revocation.
So a past revocation is a lifetime bar unless it was formally overturned. What about criminal history?
This is highly tested. An applicant must not have been convicted of or pled guilty or nolo contender to a felony in any court during the 7-year period preceding the date of the application.
7-year look back for any felony.
Or at any time if the felony involved an act of fraud, dishonesty, a breach of trust, or money laundering.
Or ever, if it was a financial or trust-related felony. That 7-year period for general felonies versus at any time for financial trust felonies is a critical distinction you must know.
Absolutely. What else?
They must have completed the pre-licensing education requirements and passed the applicable licensing tests. We'll detail those requirements shortly.
Education and testing. Makes sense.
They must have met either a net worth or surety bond requirement or paid into a state fund as applicable. This provides some financial backing and varies by state.
Financial requirements, okay.
And finally, a broader standard. They must have demonstrated the financial responsibility, character, and general fitness such as to command the confidence of the community. This allows regulators some discretion based on overall background.
Financial responsibility, character, fitness. Got it.
As part of the application process, loan originators must submit to rigorous background checks. What do these include?
They include submitting fingerprints for a state and national criminal history background check, authorizing checks for any relevant civil or administrative records, and obtaining a credit report through the NMLS. These are standard parts of the vetting process.
Okay, background checks are standard. Now, education requirements. Specific hours are crucial for your exam here. Let's start with pre-licensing education, PE.
To get licensed initially, applicants must complete at least 20 hours of NMLS-approved education.
20 hours total PE. Does it have specific components?
Yes, and these specific hour breakdowns are frequently tested. The 20 hours must include 3 hours of federal mortgage laws and regulations, 3 hours of ethics, which shall include instruction on fraud, consumer protection, and fair lending issues, and 2 hours of training relating to lending standards for the non-traditional mortgage product marketplace.
Okay, 3 federal law, 3 ethics, fraud, fair lending, 2 non-traditional mortgages. That's 8 hours of specific topics within the 20 total hours. The remaining 12 can be electives or state-specific content.
Exactly. You need to know that 332 break down within the 20 PE hours. Now for continuing education, CE.
What's required annually to maintain a license?
Following initial licensure, LOs must complete at least 8 hours of NMLS-approved education annually.
8 hours total CE annually. Does it have a similar breakdown?
Yes, it does. The 8 hours must include 3 hours of federal mortgage laws and regulations, 2 hours of ethics, including instruction on fraud, consumer protection, and fair lending, and 2 hours of training related to lending standards for the non-traditional mortgage marketplace.
Okay. 3 federal law, 2 ethics, 2 non-traditional. That's 7 hours of specific topics within the 8 total CE hours. Notice the slight difference in ethics hours, 3 PE versus 2 CE.
Good catch. Knowing those specific CE hour breakdowns, 322 within 8 total, is also critical for the exam.
Now for testing requirements. These scores and retake rules are highly tested topics themselves. Pay very close attention here.
What's the passing score on the NMLS national test?
The required passing score is 75%.
75%. Okay. What if you fail?
Applicants are permitted to take the test 3 consecutive times, but there must be at least 30 days passed between examinations. So you can take it, wait 30 days, take it again, wait 30 days, take it a third time. What happens if you fail all 3 attempts?
If an applicant fails the test 3 consecutive times, they must wait at least 6 months before taking the examination again.
6 months. That's a significant waiting period if you fail 3 times in a row. Definitely remember the 30-day wait between attempts 1, 2, and 3, and the 6-month wait after the 3rd failure.
Absolutely critical timeframes. And here's another critical point. A definite exam hotspot regarding inactivity.
What's that?
If an individual takes and passes the licensing exam, but then fails to maintain a valid active LO license for a period of 5 years or longer, they will be required to retake and pass the NMLS exam again before being approved for licensure.
5 years of inactivity means retaking the test. Got it. That 5-year mark is important.
Very. Finally, under the SAFE Act standards, what constitutes a lack of demonstration of financial responsibility? This relates back to that character and fitness standard.
Right. When might regulators decide someone isn't financially responsible enough to be an LO?
An applicant is not regarded as financially responsible if they've shown disregard in managing their own financial condition. The SAFE Act model state law suggests this may be evidenced by current outstanding judgments, except judgments solely as a result of medical expenses.
Okay, judgments except medical are a red flag.
Current outstanding tax liens or other government liens and filings.
Tax liens are bad.
And/or foreclosures, or a pattern of seriously delinquent accounts within the past 3 years.
Recent foreclosures, or a pattern of serious delinquencies. These are specific financial red flags that state regulators will look at during the background check and credit report review.
Exactly. It's about ensuring public trust.
Our last major act for this deep dive is the Home Mortgage Disclosure Act, or HMDA, which is implemented by Regulation C.
HMDA Regulation C. This act plays a critical role in fair lending oversight, providing transparency into lending patterns across communities. It's all about data collection and analysis.
What's its primary goal?
The primary goal of HMDA is to identify urban areas where the availability of home financing at reasonable terms is limited, and to help identify potential discriminatory lending patterns.
How does it achieve this? What are its specific purposes?
HMDA has 3 specific purposes, verbatim from our source, which explain its broad impact. First, determine if depository institutions are meeting the housing needs of their communities, particularly in urban neighborhoods. This ties into things like the Community Reinvestment Act.
Meeting community needs. Okay.
Second, identify discriminatory lending practices and patterns. This is a huge one. The data helps regulators and the public see if lenders might be redlining or discriminating against protected groups.
Identify discrimination. Makes sense.
And third, determine how to distribute public sector investments where they are needed. The data can show where private lending might be lacking, guiding public investment. Its implementing regulations are Regulation C, found at 12 CFR Section 1003 at SIC.
So which institutions are covered by HMDA? Who actually has to collect and report all this data?
It applies to both depository institutions, banks, credit unions, and non-depository lenders, mortgage companies, that meet certain criteria, including generally having a home or branch office in a metropolitan statistical area, MSA, those larger urban areas.
Okay. What are the criteria for depository institutions?
Depository institutions are subject to HMDA reporting if they meet several conditions. They must meet an annually adjusted asset size threshold. The outline example was institutions with $58 million or less as of December 31st, 2024 are exempt for 2025 reporting. They must originate at least one home purchase loan or refinance secured by a first lien in the preceding calendar year. They must conduct business as a federally insured or regulated institution, or make federally insured guaranteed loans or originate loans intended for sale to the GSEs. And finally, they must meet a specific loan volume threshold.
Okay. Asset size, location, type of business, and loan volume. What's that loan volume threshold? Is it the same for non-banks?
Yes, there's now a uniform loan volume threshold for both depository and non-depository institutions, which is crucial for the exam. An institution is a HMDA reporter if it originated at least 25 closed-end mortgage loans in either of the two preceding calendar years, or at least 200 open-end lines of credit, HELOCs, in either of the two preceding calendar years.
25 closed-end loans or 200 open-end lines in either of the last 2 years. You definitely need to remember those numbers, 25 and 200. If you meet either of those thresholds, you're likely reporting under HMDA.
Correct. Those are the current volume triggers.
Lastly, what transactions are subject to HMDA? What specific loan activities get reported?
A transaction is reportable under HMDA only if it's an application for, origination of, or purchase of a covered loan.
Application, origination, or purchase. What's a covered loan for HMDA purposes?
A covered loan includes consumer purpose closed-end loans and open-end lines of credit that are secured by a dwelling. So most standard mortgages and HELOCs. It also includes business purpose closed-end loans and open-end lines of credit that are secured by a dwelling and are purchase loans, home improvement loans, or refinances.
Interesting. So HMDA covers some business purpose loans if they're for buying, improving, or refinancing a dwelling, unlike RESPA and TILA, which generally exclude business purpose.
Exactly. That's another key distinction for HMDA. Its dwelling secured scope is quite broad. For HMDA, dwelling is defined similarly to other regs. A residential structure, whether or not attached to real property, located in a state of the United States of America, District of Columbia, or Puerto Rico. This includes individual condominium units, cooperative units, or mobile or manufactured homes.
Okay. And remember, the reported data for HMDA is not limited to just loan originations. Financial institutions must also report detailed information on loan applications, including those denied or withdrawn, loan denials with reasons, loan approvals, including those not accepted by the applicant, and loan purchases when they buy loans from other institutions.
This comprehensive reporting of the entire application lifecycle, including borrower demographic data, that government monitoring info we discussed under ECO, allows for robust fair lending analysis, helping regulators and the public identify potential redlining or other discriminatory patterns, which circles back nicely to ECOA's goals. The data drives fair lending enforcement.
Wow. We certainly embarked on an extensive journey today, unpacking the core federal regulations that govern the mortgage industry. It's a lot to absorb.
It really is. From RESPA's crucial focus on protecting consumers from excessive settlement costs and ensuring clear disclosures about the closing process,
to ECOA's unwavering stance against discrimination on those prohibited bases like race, sex, age, and marital status. We've covered a lot of ground.
And we explored TILA's vital mission for credit transparency, uniform cost statements like the APR, and that critical right of rescission for certain loans secured by a primary home.
Then we delved into TILA's deeper components like HOEPA and HPMLs with their specific, highly tested rate and fee thresholds for high-cost and higher-price loans.
Right, knowing those triggers is non-negotiable. We also hit the intricacies of the LO compensation rule preventing harmful steering and dual compensation.
And the essential Tri-D forms, the loan estimate and closing disclosure, with their critical timelines, delivery requirements, and tolerance rules. So much detail there.
Definitely. We also covered the Homeowners Protection Act, HPA, which provides those clear paths for PMI cancellation at 80% and 78% LTV.
Alongside the SAFE Act's comprehensive standards for licensed professionals, the education hours, 20 PE, 8 CE, testing rules, 75% pass, 3 attempts, then 6 months, background checks, and financial responsibility requirements.
And finally, we looked at HMDA's vital role in fair lending oversight through data collection and reporting, helping to ensure institutions meet community needs and don't engage in discriminatory practices.
The true value of this deep dive isn't just in memorizing all these facts for the SAFE exam, though that precision is absolutely paramount for achieving your perfect score.
You really do need that textbook fidelity for the test. But beyond that,
It's in understanding the why behind each regulation. Knowing these rules ensures you not only pass with flying colors, but also become an ethical, compliant, and highly effective loan officer. You'll be protecting consumers and building trust in the industry.
absolutely, these aren't just abstract laws to memorize for a test. They are the fundamental foundation of responsible lending and are critical for a successful long-term career. They guide your daily actions.
So here's a final thought to chew on as you prepare to conquer your exam and navigate your career. As the mortgage industry rapidly evolves with new technologies like AI, machine learning, and maybe even blockchain, fundamentally changing how loans are originated, underwritten, and serviced. How will these foundational consumer protection acts, RESPA, ECOA, TILA, and the others continue to adapt, be interpreted, and be enforced in an increasingly digital and automated lending landscape?
That's a fascinating question. How do you ensure fairness and transparency when algorithms are making decisions? How do you provide disclosures effectively in a purely digital environment? The principles will remain, but their application will certainly evolve.
Something to think about. But first things first, focus on mastering these core rules as they stand today. You've got this deep dive as your guide. Go ace that SAFE exam.
You can definitely do it. Good luck.